Welcome to the Deep Dive. We're the show that, well, cuts through the noise to give you that shortcut to being genuinely well-informed.
And that's the goal.
And today, we're plunging into a world that's often full of, let's say, mystery and quite a bit of ambition. Financial trading.
Right. High stakes, high pressure.
Exactly. But look, this isn't going to be about finding some magic formula or, mastering complex algorithms. Not at all. We're actually exploring a really counterintuitive path to success here, drawing insights from a high-stakes trader who's genuinely seen it all.
And it's a path that forces you, really, to challenge almost everything you think you know about winning. Not just in markets, maybe. Maybe even in life itself.
That's a big claim, but I think it holds up. I mean, have you ever stopped to wonder why, even with all the amazing tools, the super fast data, all the information flooding in, why a staggering 90% of individual traders still fail?
That's a huge number. Yeah. 90%.
It's a massive paradox, isn't it? And our discussion today, our deep dive, really aims to unravel that specific mystery. Okay, so let's unpack this.
Yeah, and if we connect this to the bigger picture, what we're getting into today, it's really less about trying to decipher complicated market charts. You know, it's much more about profound self-analysis, understanding ourselves first, fundamentally.
Before you even try the markets.
Exactly.
Yeah.
Because that, as we're going to discover, is maybe the far greater challenge than most people ever realize.
That really does flip conventional wisdom completely on its head, doesn't it?
It does.
So our main source for this fascinating journey is the book Best Loser Wins: Why Normal Thinking Never Wins the Trading Game. It's by Tom Hougaard. And what really makes this stand out, I think, is that it's not another one of those typical how-to trading manuals, filled with strategies and indicators.
No, far from it.
This is a proper deep dive into the mindset you need. The internal game required to navigate the, frankly, treacherous and often emotionally brutal waters of the financial market.
Yeah, the psychological battlefield, really.
That's a good way to put it. And Tom Hougaard himself, he's quite a figure in this world. He's 52 now, but his story started 3 decades ago. Left Denmark, went to London specifically to trade.
Right, not just dabbling. He committed early on.
Absolutely. And he's not just some armchair theorist either. He's got the academic chops, a bachelor's in economics, a master's in money, banking, and finance. Even worked for J.P. Morgan Chase for a bit.
So he understands the traditional financial world.
He does,
Yeah.
But the real credibility, the really compelling part, comes from his time as a private high-stakes trader. We're talking risking anywhere from £100 up to 3,500 pounds per point on a trade.
That's serious risk, serious conviction.
Yeah, it really is. And just to give you some context, this is someone who documented making £325,000 in a single month, and he did it publicly with real-time timestamp entries and exits that his followers could see.
Wow. So complete transparency.
Exactly. This isn't just theory spun out of thin air. It's battle-tested, real-world experience. And that's what makes his insights, I think, so incredibly potent and worth digging into. So Tom's fascination with markets, it actually kicked off incredibly early. He was just 10 years old, apparently sparked by a newspaper competition.
Just 10? Wow.
Yeah, you can just picture that sort of initial, almost innocent curiosity, right? Seeing numbers move, imagining what it all meant, the thrill of it.
And what's really fascinating here is how that early sort of childlike wonder contrasts so sharply with his formal education later on. I mean, despite getting 2 pretty rigorous degrees of BSc in economics, an MSc in money, banking, and finance, Hougaard found that, conventional economic thinking.
The stuff he was taught.
Yeah, the intricate models, even the ones championed by Nobel Prize winners, they just failed. They simply failed to capture the market's true, often chaotic complexity.
That must have been a huge realization for someone steeped in that academic background.
Absolutely. It meant all those sophisticated formulas, all the predictions he'd learned, they just couldn't account for the unpredictable human element that really drives prices. He realized quite profoundly that the markets are not an equation to be solved.
Not a math problem.
Not at all. Instead, he came to understand that the markets were actually sending him a different message, a more personal one, sort of telling him, stop trying to understand you, meaning the market. It told him, understand myself.
Okay. That's a powerful shift. From analyzing the external world to this intense internal introspection.
Totally transformative.
So before he became the full-time private trader we know, his initial professional life included that stint at J.P. Morgan Chase. It wasn't a direct trading job, apparently, but he worked in portfolio analysis, which meant he was observing markets unfolding day in, day out. He actually calls it an invaluable experience.
Just soaking it all in.
Yeah, he apparently used to sneak into the office on weekends, just devouring analysis and data on the Bloomberg terminal he happened to sit next to, just absorbing everything he possibly could.
That shows real dedication, doesn't it? Going above and beyond.
Oh, completely. His work ethic there sounds pretty legendary. He consistently clocked over 40 hours of overtime, monthly, for nearly 3 years. And not just logging hours, but really immersing himself in the mechanics of the market.
Getting under the hood.
Exactly. He actually connects this drive to what he calls the Navy SEALs ethos. He says, anything in life worth doing is worth overdoing. Moderation is for cowards.
Intense.
It really shows that intensity, that dedication he brought to learning the game right from the ground up, that sort of relentless pursuit of mastery.
Indeed. And this rigorous approach, it eventually led to a really pivotal and maybe somewhat fiery moment, which Hougaard talks about very candidly. He calls it the Marconi garbage story.
Right. I remember reading about this.
So during his time as his words glorified media whore for a brokerage.
Okay.
Essentially, his job was giving financial analysis to clients. He had this encounter at Royal Ascot, the famous high society horse racing event.
The fancy hats, champagne.
Exactly. Picture the scene. All that glitz. And here's this young, earnest analyst trying to offer some sober financial advice.
So one of the firm's big clients, apparently a pharmacist from Luton, corners Tom, asks him what he thinks about Marconi.
Marconi. That takes me back.
Yeah, this was a FTSE 100 company that had just plummeted from 1,200 pence down to 450 pence. So you can almost hear the hopeful tone in the client's voice, right? Maybe seeing a bargain?
Thinking it's cheap now.
Exactly. But Tom's response was, well, blunt, unfiltered, and ultimately career-altering. He just said, Marconi is garbage, gentlemen. Why are you chasing stocks that have fallen in price?
Ouch. Direct.
He directly challenged that common, deeply ingrained idea that, falling prices automatically mean something's cheap or a bargain opportunity.
And this is such a crucial early aha moment for Hougaard. It's about that fundamental difference between market logic and consumer logic.
Right.
He states it so clearly. The stock market is not like a supermarket where it makes sense to buy toilet paper when there's a sale on.
Makes sense when you put it like that.
Think about it. Supermarket, 50% off toilet paper. It's a no-brainer. You stock up. But in the financial markets, a stock that's fallen over 50%, it isn't necessarily cheap. It might just be, as he put it, garbage that's actually headed even lower.
Or to zero.
Or potentially to zero. The market often discounts things for a very, very good reason, not just because it's a temporary sale.
So what happened to Tom after that? The consequence?
He got fired. Simple as that. For being right.
Unbelievable.
His boss had clients who were long Marconi. They owned it. They were apparently going to lose fortunes. His honest, maybe brutal assessment was just not what the firm wanted its clients hearing.
The messenger got shot.
Pretty much. His boss's version of it, anyway. Later that year, Tom was on CNBC. Marconi had fallen even further, down to some 2 pence, and Tom flat out predicted it would go to zero.
And did it?
It did. But fortunately for him, his honesty and that sharp market insight, even if it was controversial, actually landed him a new job at City Index the very same day he got fired.
Wow. Okay. So his reputation preceded him, in a good way for some. Seems like it. He then spent 7 really intense years on their trading floor, witnessing millions of trades, before becoming the private, high-stakes trader we're really focusing on today, risking those astonishing sums per point.
So that experience, getting fired but then immediately hired, must have taught him so much about the brutal reality of market dynamics and, crucially, human psychology under pressure.
Absolutely. A trial by fire.
Now, another really defining moment you mentioned in Tom's journey was encountering Michael Lewis's book, Liar's Poker.
Ah, yes, a classic.
He read it when he was home from school with the flu. His dad brought some books home from the library, and that was one of them. You can just imagine young Tom maybe sprawled on the couch, just devouring every single word.
It's quite ironic when you think about it, isn't it? Michael Lewis famously wrote Liar's Poker as a warning. A vivid picture of the excesses, the gluttony of 1980s Wall Street. He intended it to deter bright young minds from that path.
Right, it was meant to be cautionary. Exactly. Yet for young Tom, and probably thousands of others, it had the completely opposite effect. It was pure inspiration. It solidified his belief that trading was his true calling, his vocation.
So the warning became an invitation.
Precisely. He describes being hooked, realizing that despite its cautionary intent, it was actually the perfect starter book for his journey. It painted this picture of a world that was both thrilling and incredibly challenging, a place where sharp minds could really thrive.
And it genuinely transformed him, didn't it? He says he went from being a skateboard-loving football fanatic to a focused and driven individual. He'd found his calling. And with that came this almost obsessive drive.
A real sense of purpose.
Definitely. This newfound purpose fueled an immense effort just to fund his university studies. He worked day and night, juggling a job at a pension fund with shifts at an amusement park until 1 a.m., all just to save enough money to avoid going into debt.
Incredible work ethic.
And he was absorbing information constantly, even reading English books just to improve his language skills, all focused on this singular goal, entering the financial world. His first really big trade, though, was actually completely accidental, a stroke of incredible luck during what we now know as Black Wednesday. That was September 1992.
The day the UK crashed out of the ERM. Chaos.
Total chaos. The pound collapsed against other currencies. And while George Soros famously made $1 billion that day by strategically betting against the pound...
The man who broke the Bank of England, as they say.
Right. Tom's profit was pure serendipity, just sheer luck.
How did that happen?
Well, he was literally walking to his local bank in Denmark to convert his savings, the money he'd worked so hard for, into British pounds for university. And as he was doing that, the currency market was in absolute turmoil. By sheer luck, the timing was perfect. He exchanged his Danish kroner at a rate of about 9 kroner to the pound. Just days earlier, it would have been nearly 12.
Wow, so he got way more pounds than he expected.
Exactly. This windfall meant an extra 4,000 pounds landed in his account, which was huge considering his entire annual budget for tuition and lodging was only about 2,500 pounds.
That's incredible luck.
As he puts it, kind of humorously, Uncle George made my university education debt-free.
Nice way to look at it.
It was this moment of extraordinary fortune that, maybe looking back, served as a very early, perhaps unappreciated lesson at the time in just how volatile and unpredictable markets can be.
Yeah. Soros had this calculated high-conviction bet. Tom just had pure, unadulterated good luck, a random walk down the currency lane.
That Black Wednesday windfall was pure luck, sure. But speaking of these extraordinary market events and the crucial lessons they hold, Tom shares another really powerful anecdote. It crystallizes the dangers of what he calls normal thinking. He calls it the parable of the hot dog in Paris.
Okay, intrigued. A hot dog.
Yeah, so he heard this story circulating in the city of London about an Englishman who apparently turned a £5,000 account deposit into an absolutely astonishing £8 million profit during that same Black Wednesday period.
5,000 to 8 million? Seriously.
Seriously. And this guy wasn't even a professional trader. He owned a printing company. His big insight came from a holiday in Paris where he was just utterly shocked by the price of a hot dog.
Okay.
So he then systematically started comparing prices of various everyday good stuff in Parisian supermarkets to the prices back in London. And he concluded, quite intuitively, based on this simple comparison, that the French franc was hugely overvalued relative to the pound.
Right. Purchasing power parity, basically, but done with hot dogs.
Exactly. And he then relentlessly traded on this conviction, shorting the franc, presumably.
Okay. That's an amazing story in itself, but where does it go from there?
Well, here's where it gets really interesting. And this is where the core lesson of the book, the reason we're even talking about this, truly starts to emerge.
Okay.
As amazing as that story sounds, 5K to 8 million pound, it's the stuff of trading legends, right? The critical twist, the part people usually leave out, is that the Englishman later went on to lose all of that money.
All 8 million?
All of it. And then some.
Ouch. Okay, that puts a different spin on it.
Completely. And this anecdote powerfully illustrates the central problem this whole deep dive is trying to solve. It highlights that. And this is a key quote. Quote, "What 99% of people do not realize is that when you win, there are things happening in your brain chemistry which, if left unnoticed and unchecked, will have a detrimental effect on your decision-making."
The brain chemistry of winning. Dopamine hits. Overconfidence.
Exactly. When you have a massive win like that, your brain gets this huge dopamine hit. It's a powerful reward, this surge of pleasure, maybe perceived invincibility, and it can subtly, dangerously lead you straight into overconfidence. Your discipline loosens. You start taking on more risk than you should, convinced that success will just keep repeating itself.
So the very act of winning can actually set you up for future failure if you're not incredibly self-aware.
Precisely. It's a dangerous feedback loop. Hashtag 2. The harsh realities of the trading floor and normal behavior. And that story, that rapid rise and even more rapid fall, it just perfectly underscores something fundamental about trading environments, doesn't it? Tom vividly describes the trading floor itself as nothing less than a gigantic melting pot of human emotions.
Yeah, you can almost feel the energy, the chaos, just from his descriptions.
Totally. Imagine the sheer, unbridled chaos of that place. Rapid-fire decisions, millions changing hands every second, and just this overwhelming display of raw human feeling all playing out in real time.
He tells some wild stories, like seeing a colleague literally kick his PC repeatedly. So hard it had to be replaced. Just this physical manifestation of frustration.
Makes your average office tantrum look pretty tame.
Right. Or he mentions a Russian client who got a $10 million margin call, meaning he needed to deposit $10 million immediately just to cover his losses.
$10 million?
And the guy just casually wired the funds over by 7 a.m. the next morning like it was nothing, like ordering coffee.
The scale is just mind-boggling.
It is. And the trading floor becomes this crucible where emotions just run wild and completely unfiltered. He lists them out. Impulse buying, panic selling, holding on to losses, refusing to admit defeat, greed, stupidity, stubbornness, despair, tears, abject depression, exhilaration, and excitement.
Wow, the whole spectrum.
The whole spectrum, often in incredibly quick succession, like this manic roller coaster of the human psyche. And it's really hard to reconcile that chaotic human drama with the neat illusion of a finely tuned global economic environment that you might read about in textbooks.
No kidding. And despite all this raw emotion, all this intense activity, the truly successful trader, the one who lasts, they seem to remain this incredibly elusive figure.
Yeah, finding consistency is the real challenge.
Tom mentions this revealing conversation he had with the CEO of a London trading company. The CEO, who'd spent over 30 years on trading floors, could barely remember any genuinely good traders.
Not many long-term survivors.
Exactly. He said lots of clients made a lot of money at times, sure, huge wins, but very, very few managed to actually keep it consistently over the long run.
And the data backs this up, right?
Strikingly so. The CEO shared that almost all clients have more winning trades than losing trades. Which sounds great on the surface, doesn't it? You'd think, okay, they're winning more often, they must be profitable.
That's the trap.
That's the trap. Because the reality is, for every pound they win, they lose about £1.66.
Wow. So the losses just dwarf the wins, even if the wins are more frequent.
Precisely. It's the core paradox. You win more often than you lose, but you still end up losing money overall. Why? Because those small winners are just too small. And the few losers you have, they're way too large. They just eat away at all the accumulated gains.
Like picking up pennies in front of a steamroller, as the saying goes.
That's a perfect analogy. And brokers, ironically, they actually want their clients to win because winners keep trading, generating commissions.
Right. It's in their business interest for clients to succeed.
So they provide every tool under the sun. Favorable spreads, news feeds, sophisticated charting packages, tons of analytical tools, all designed to help clients succeed.
And yet,
the outcome remains stubbornly the same. Most people will fail. The failure rate is astronomical. It's almost as if the tools themselves aren't the problem, or even the win rate. Something else is going on.
Something deeper. The human element again.
So what does this all mean? Why is it that, as Hougaard puts it, normal is a loser? Especially today, when you could argue market conditions are better than ever for individuals. Spreads are tighter, margins are more favorable, the tools are readily available, and there's plenty of volatility providing opportunities.
Yeah, on paper it should be easier, right?
You'd think so. Yet people are still struggling massively. So if more information and better tools aren't the answer, what is?
Well, it really comes down to what Hougaard identifies as normal behavior.
Yeah.
Which, ironically, in the context of trading, is a sure recipe for ruin.
Normal behavior is bad.
Yeah. Normal behavior involves this never-ending cycle of education, looking for the next new edge.
Constantly searching for the Holy Grail system.
Exactly. And this is fascinating because conventional advice always tells you, learn more, get more education. But for most traders, more education just feeds this destructive cycle. Why? Because they're looking for an external solution, a better indicator, a secret pattern to what is fundamentally an internal problem.
A psychological problem.
Precisely. It's also rooted in that deeply ingrained, yet utterly destructive advice to buy low and sell high.
The supermarket mentality again.
Exactly. As Hougaard points out, unlike buying discounted toilet paper, this is a sure recipe for ruin in financial markets. Markets that are falling can always fall further, much further than you might consider low. And markets that are rising, they can always rise higher, becoming way more expensive than you ever imagined possible.
So buying a falling stock, hoping for a bounce, or shorting a rising one because it must come down.
You're fighting the prevailing trend. You're going against the powerful, sustained momentum of the market. And that's usually a losing battle. And this flawed approach leads directly to that predictable and incredibly frustrating trader's cycle he describes.
Okay, what's that cycle?
It goes like this. Trade well for a while, we are happy. Our discipline weakens. Because we feel confident, maybe invincible. We lose money, often a big loss that wipes out the gains. We strengthen our resolve and we get more education. Back to searching for that external fix. We do well for a while, the cycle repeats. We lose money. We stop sometimes for a while, sometimes permanently.
Oh man, that sounds exhausting and familiar to anyone who's tried this.
It's a cruel loop, really, driven by hope and fear. But the core problem, the real kicker, according to Hougaard, is that 99% of people do not know how to lose.
Don't know how to lose. What does that mean exactly?
It means they don't know how to handle the emotional impact of taking a loss, which then leads to all sorts of self-sabotage, like holding on to losing trades way too long, hoping they'll come back, or taking profits way too early on winning trades, terrified of giving back the small gain. It's about managing the emotional fallout of being wrong.
And to really hammer this point home, Tom highlights some compelling research. It was done by David Rodriguez, who analyzed 43 million trades, executed by 25,000 FX traders over a 15-month period.
43 million trades. That's a massive sample size.
Yeah.
Statistically significant for sure, giving us a really clear picture of real-world trading behavior.
And the key finding from all that data, get this, a remarkable 62% of all those trades ended in profit.
62% winners.
Yeah, think about that. That's a good hit rate. A trader with a hit rate of 6 out of 10 should be able to make money from trading. So why didn't they?
Exactly. That's the million-dollar question, isn't it? Despite winning more often than they lost, overall they lost money. And this contrasts so sharply with, say, a professional hedge fund trader Hougaard knows. This guy apparently has a hit rate of only about 25%.
Only 25%, so he loses 3/4 of the time.
Roughly, yes. He loses 75 out of 100 trades, on average. But here's the absolutely crucial difference. When that hedge fund guy wins, he makes something like 25 times what he typically loses on his losing trades.
Okay. So the size of the wins versus the losses is completely different.
Totally different ballgame. It highlights that success isn't about how often you win. It's about how much you win when you're right, and critically, how little you lose when you're inevitably wrong.
Cutting losses quickly, letting winners run, the old adage.
Easier said than done, clearly. This also leads him to critique the literal application of the risk-to-reward ratio that gets thrown around a lot.
How so?
Well, Tom kind of sarcastically puts it, when people ask him for price targets on his trades, he says, "How on earth do I know what my reward will be? I literally do not know."
Right, the market decides the reward, not you beforehand.
Exactly. And he talks about the pain, the real emotional pain, of closing a small winner, only to watch the market continue to run significantly further in your favor. That feeling can actually be more painful, psychologically, than just crystallizing a small, manageable loss.
Which then leads to that impulse to hold losers, hoping they come back, and cut winners, locking in the small gain before it disappears.
Precisely. It's all driven by that emotional response to winning and losing. #3hack, the illusion of chart expertise and the human brain's bias.
Okay, so this brings us to a really controversial stance Tom Hougaard takes, especially in a world that seems obsessed with technical analysis and charting. He basically says everyone is a chart expert.
Yeah, that's going to ruffle some feathers.
He boldly claims that you can learn the basics of technical analysis over a weekend, which sounds almost ridiculously easy, right, given how complex people make charting seem.
And this is where the nuance comes in. While he agrees the basics are accessible drawing lines, recognizing simple patterns, he strongly emphasizes that a chart expert does not equate to a trading expert. They are not the same thing at all.
Meaning, knowing the tools doesn't mean you know how to use them profitably.
Exactly. He sees many new traders, in their understandable eagerness for an edge, just plaster their charts with so many tools that they can barely see the price chart itself.
Indicator overload.
Totally. Moving averages, Bollinger Bands, RSI, MACD, stochastic, Fibonacci, a dozen different things, all piled on top of each other, just creating this overwhelming visual noise.
So what does his chart look like?
By contrast, Hougaard's own charts are starkly minimalist. He says there is not a single indicator on them, not a single one.
Wow. Just price.
His focus is purely on price itself.
Yeah.
He views indicators as essentially distortions of the reality. They're filtered, lagging information that can often mislead you, pulling your focus away from what the price is actually doing right now.
So indicators are just noise generators for him?
Largely, yes. He quotes a friend who said something like, indicators, they all work some of the time, but none of them work all of the time. The deeper truth, he insists, the real differentiator, is that what separates the 1% from the 99% is how they think when they are in a trade, how they handle their emotions when they trade.
So it's not about the lines on the screen.
It's about the lines in your mind, how you manage yourself under pressure.
Okay, and this feeds directly into what he calls the curse of patterns, which introduces this psychological concept of apophenia, or patternicity.
Right, patternicity, our brain's tendency to see patterns everywhere.
Yeah, our inherent, almost primal tendency to perceive meaningful patterns and connections, even in random or unrelated events. It's why we see faces in clouds or, religious figures on a piece of toast.
Our minds are hardwired to seek patterns. It's how we make sense of a chaotic world. But this very wiring becomes a significant liability in trading because we tend to seek the information that confirms the bias that we have already decided upon. Confirmation bias, basically. This makes genuine objectivity in chart analysis virtually impossible.
You see what you want to see.
Exactly. As the old saying goes, we don't see things as they are, we see them as we are. Our internal state dictates our external perception. Hougaard gives this example of his friend Nick. Nick was once a great trader, apparently. But then he started reading some really bearish commentary on the market. And after that, he stopped trading what he actually saw on the charts. Instead, he let his negative opinion, his bias, cloud his objectivity.
So he fought the trend.
He just kept shorting a rising market, absolutely convinced it had to go down because of what he'd read. And eventually his edge just evaporated. He stopped trading altogether. His internal bias completely overwhelmed the external reality of the market.
And this pattern-seeking, pain-avoiding brain of ours, that's also why we fall for what he calls the trend line fanatical approach.
Oh yeah, that's selective memory with trend line.
Explain that.
Well, you draw a trend line. If the price bounces off it perfectly, you highlight it, maybe screenshot it, feel like a genius. If the price slices right through it, you just quietly erase the line or ignore it and draw a new one.
Yeah, I can see that.
Our brains, with their prime objective being to avoid the pain of being wrong, and thus losing trades, will selectively ignore the setups that don't work. We conveniently forget all the failed trend lines. This creates this completely distorted image of the tool's validity. It makes us believe it's some kind of holy grail when it only seems to produce winners because we've mentally airbrushed out all the failures.
So we cherry-pick the evidence.
Constantly. And this is starkly evident in the widespread, almost dogmatic use of things like Fibonacci ratios.
Fibonacci, the magic numbers.
Right. Hougaard points out that in his own analysis of major S&P 500 retracements, he found not a single one of these three major retracements is identified by either 38.2%, 61.8%, or even 78.6% ratios. Those classic Fib numbers just weren't showing up consistently at major turning points.
But so what did show up?
Instead, he often saw completely different numbers, like 43% or 74%, which he largely attributes to, well, randomness. But he says, we want to believe there is a magical growth sequence in the markets. We want to believe there's some hidden mystical order that we can decode with these special ratios.
It gives us a sense of control, maybe.
Exactly. A sense of predictability in an unpredictable environment. He even exposes what he calls the fraud of the candlestick guru, a really prominent figure who wrote books and courses promoting countless complex candlestick patterns.
Okay, what was the fraud?
This guru later admitted, apparently, that he didn't actually trade these patterns himself, or even trade at all. He simply invented as many patterns as he possibly could in order to fill pages in books and courses.
You're kidding. Just made them up.
According to Hougaard, yeah. Because people are desperate for a simple visual solution, a quick fix. And this powerfully illustrates how that desire for an easy answer can lead traders completely astray, making them susceptible to clever marketing over genuine market insight.
Wow. Okay, so all of this, the biased perception, the flawed tools, the emotional cycles, it really boils down to one critical truth that Tom Hougaard hammers home again and again. Good trading goes against human nature.
Yeah, that's the crux of it.
It feels so counterintuitive, doesn't it?
Mm-hmm.
We seem inherently wired to do the exact opposite of what's required for consistent profitability in the markets. Why? Why is our natural wiring so detrimental in this specific arena?
It's essentially a battle against your deepest, most primal instincts. Think back to our supermarket mentality. We are just hardwired to seek bargains. If toilet paper is 50% off or you see a winter jacket heavily discounted in the middle of summer, we're drawn to it. We feel this sense of joy to know we have bought something which is cheap.
Right, it feels smart, economically rational.
And it is smart in the consumer world. It serves us incredibly well there. However, Hougaard states, unequivocally, the world of trading is diametrically opposed to the world outside trading. The traits I display as a human being outside my world of trading don't serve me well in the world of trading.
The rules are completely different.
Completely inverted in many ways. Through extensive self-analysis, meticulously logging not just his trades but his reasons for taking them, Tom realized he was, in his early days, a prolific value trader, meaning he was repeatedly shorting rising markets and buying falling markets, doing exactly what feels natural, buying the dip, selling the rip.
It's a supermarket approach.
Exactly. And realizing this, then consciously deciding to do the opposite, embracing the uncomfortable act of buying what's already expensive because it's trending up, or selling what's already cheap because it's trending down. This counterintuitive shift was, he says, a significant factor to my trading success, going from being a losing trader to a winning trader.
So embracing the discomfort of going with the trend, even when it feels too high or too low.
Precisely. And indicators like stochastics, which signal overbought or oversold, they just reinforce this flawed, cheap versus expensive fallacy.
Yeah.
The perverseness of the financial markets, he argues, is that it generally makes sense to buy something because it is more expensive today than it was yesterday. Why? Because that strength, that rising price, indicates it's likely in a strong uptrend that might continue.
It's really unsettling when you realize how easily our brains can be tricked, even by simple things like optical illusions. And if that's true for basic visual perception, it must be exponentially more challenging in the dynamic, high-pressure world of trading, right?
Oh, absolutely. The pressure cooker environment just amplifies all our cognitive biases.
Tom uses various examples to illustrate this, like optical illusions, but critically, he brings in the concept of cognitive dissonance to show how our subconscious mind tends to misinterpret information, especially when we're under stress.
Yeah, the dissonance is key. Think about simple visual tricks first, like the FedEx logo, the arrow hidden between the E and the X.
Yeah, once you see it, you can't unsee it.
Exactly. Yeah. But many people don't see it initially because their brain isn't actively looking for an arrow there, or that famous MIT checkerboard illusion. You have two squares, A and B, on a checkerboard. One looks dark, one looks light because of a shadow cast over it, but they are actually the exact same shade of gray.
But your brain insists they're different.
Right. Because of the surrounding context, the perceived light and shadow. Our brain interprets, it doesn't just see raw data. He even describes using a color word test in a speech. The word red was written in blue ink. He asked people to say the color of the ink.
And people shouted red?
Many did, instinctively. Because our brain, seeing the word red, wants us to say red even when the actual answer to the question, what color is it, is blue. He says, it is as if we consciously need to stop the brain from jumping to conclusions.
And that directly translates to trading.
Directly. We often see things that are literally not there. We project our hopes, our fears, our biases onto the chart. And crucially, charts do not work as well in real time as after the fact. Hindsight analysis is easy. Real-time interpretation under pressure is incredibly hard because of these biases. And this brings us squarely to cognitive dissonance in action during a trade. Tom tells this story about a friend who was in a winning short trade on the DAX index. But he was really struggling to hold on to it. Why? Because he'd had a losing day yesterday and a losing trade earlier that morning.
So he wanted to lock in the win quickly to make up for the losses.
Exactly. He desperately wanted to close that profitable trade to make up for the lost trade this morning, and I can recover a lot of the points lost yesterday. He was experiencing intense mental discomfort.
Because he held two contradictory ideas simultaneously.
Precisely. Cognitive dissonance is that mental discomfort experienced by an individual who simultaneously holds two contradictory beliefs or ideas. In his friend's case, belief 1, the market is going down, my short trade is working, I should hold it. Belief 2, I feel terrible about my previous losses, closing this winner now will make me feel better and recoup some money.
So the mind tries to resolve that conflict.
And when confronted with facts or situations that contradict our existing beliefs or emotional state, our rational mind scrambles to reduce that discomfort. In trading, the solution it often defaults to is dangerously counterproductive, as Hougaard puts it. The best way for your rational mind to resolve the discomfort of a profitable position is to close it. Get rid of the tension of potentially losing the gain. The best way for the rational mind to resolve the discomfort of a losing position is to let it run, because closing it crystallizes the pain, while holding it keeps hope alive.
Which is the exact opposite of what profitable trading requires. Cut losses, let winners run.
Diametrically opposed. The true source of all this internal turmoil, Hougaard argues, is fear. Pure and simple. Fear of loss, fear of missing out, fear of being wrong, fear of giving back profits. People end up trading their own mental well-being, their desire to feel good right now, to avoid pain right now, instead of trading what the market is actually telling them.
Trading emotions, not the chart.
Exactly.
Yeah.
He also shares that great thunderbolt moment from Dr. David Paul, another trader he respects. Paul's staring at his screen, convinced the market had to go up based on his sophisticated software and what his trading buddies were saying. But the market was clearly falling. His wife, with no trading background, just walked past, looked at the screen, and innocently asked, "All I see is that this market right now is going down, isn't it?"
Uh-huh. The emperor has no clothes.
Precisely. And Paul had this sudden realization. I wasn't trading the market. I was trading my opinion. His internal bias, reinforced by his tools and peers, was completely overriding the glaring reality right there on the screen.
It really is a striking paradox, isn't it? Trading attracts these highly intelligent, ambitious, self-starting individuals. You know, the kind of people you'd absolutely expect to succeed at anything they put their mind to.
Right. The go-getters.
Yet, as we keep coming back to, around 90% of them still fail in this arena. So if it's clearly not about a lack of intelligence or information or ambition, what's the deep-seated reason for this pervasive failure?
And Tom Hougaard comes back to one fundamental underlying reason. It's something that plagues every single one of us, trader or not. Our minds have one primary objective: to protect us against perceived or real pain.
The survival instinct.
Exactly. This hardwired survival mechanism, while incredibly useful for our ancestors running from saber-toothed tigers, actively works against successful trading. It drives a whole host of self-destructive behaviors that we've touched on.
Like holding losers too long.
Right. Why do we do that? Because hope, the hope that the trade will turn around, keeps the immediate pain of crystallizing the loss at bay. It postpones the reckoning.
And cutting winners too soon.
That's driven by the fear of losing what I made on paper. The desire to lock in that small dopamine hit of a gain before it potentially vanishes. It's about avoiding the future potential pain of seeing a winner turn into a loser.
Even doubling down when losing.
Even that, increasing your stake when you're losing, averaging down on a bad bet, that's often driven by a subconscious, almost desperate need to get rid of pain quickly by making it all back in one go. It feels like taking control, but it's usually just compounding the error. He states it very clearly. As long as a losing position is open, there is hope that the position will turn positive. The moment you close the position and you crystallize the loss, the pain of the loss becomes real. And our brain desperately wants to avoid making that pain real. This deeply ingrained aversion to immediate pain sabotages rational decision-making at almost every critical juncture in trading.
Okay, so if pain avoidance is such a powerful, almost insurmountable force wired into us, how on earth do we counter it? Tom introduces a really counterintuitive motivator here, one that most of us actively try to avoid feeling: disgust.
Yes, disgust. It sounds strange, but he argues it can be an incredibly powerful catalyst for change. He draws on some intensely personal anecdotes to illustrate this.
Like what?
Well, he talks about his own childhood poverty. Experiencing that created a visceral disgust for being poor, which, he says, motivated him to become a prolific hoarder of money early on. It drove his saving and work ethic. He also mentions observing his girlfriend's battle with anorexia, seeing how powerfully negative imagery and the desire to move away from a current state could motivate action, however destructive in that case.
So moving away from pain is stronger than moving towards pleasure.
He posits exactly that. Away-oriented goal setting is a much stronger motivational force than towards-oriented. He uses the weight loss example. Imagine you want to lose weight. What's more compelling, a picture of your perfect, ideal future body, or a stark, unflattering picture of yourself at your heaviest attached? The picture that evokes a deep sense of disgust or dissatisfaction with your current state.
I can see how the negative picture might light more of a fire under you.
Right. He says most people, including friends he asked, chose the obese picture as the stronger, more potent motivator. It creates urgency. This concept, he argues, applies directly to overcoming bad habits or addictions, including destructive trading patterns. He talks about his own journey with alcohol hitting rock bottom.
Getting to that point of disgust with himself.
Exactly. And the therapeutic process involved stripping naked, metaphorically, facing the ugly truth, cleaning up the process, and starting fresh with a completely new mindset. He compares it to how elite soldiers are often pushed beyond their breaking point, then rebuilt stronger. This intensely uncomfortable process, driven by disgust at one's current state and a fierce desire to move away from it, provides the necessary impetus for radical change in trading too. It's about confronting the ugliness of your bad habits head-on, not pretending they don't exist.
Okay, so once that powerful motivation, maybe fueled by disgust, is sparked, the next big challenge is taming what Tom calls the drifter mind.
Ah, yes, the wandering mind.
Our brain's natural, almost constant tendency to wander off, get distracted, pull us away from intentional, disciplined action, especially when things get tough or boring. His personal mantra, one he really seems to live by, is control your mind, control your future.
It sounds simple, but it's incredibly difficult in practice. The solution he offers is, again, both trivial in its simplicity and profound in its power. You have to constantly reaffirm your purpose.
Keep bringing yourself back.
Exactly. And this isn't just about vague positive thinking. It means engaging in concrete daily practices that actively bring your mind back to your goals, back to your process. Whether that's repeating a specific mantra, a dedicated meditation practice, or consistent journaling about your trades and your mindset, he emphasizes the one you do is the best exercise, meaning consistency with something trumps finding the perfect, complex technique that you never stick with.
Find what works for you and do it relentlessly.
Precisely. For Tom himself, this includes things like publicly posting his trades online in real time.
That takes guts. Puts you right out there.
Incredible accountability, right? It keeps him focused because it exposes his potential weaknesses and losses for everyone to see. There's nowhere to hide from bad decisions. He also makes a point of reliving his past bad trades. He uses them to, in his words, torment myself, not in a purely masochistic way, but as a positive catalyst to sear the lessons into his brain and prevent repeating those painful mistakes.
Learning from the pain, not just avoiding it.
Exactly. And he makes this crucial point. For every hour you spend on technical analysis, you must set aside at least 25% of that time for what I call internal analysis. It's about truly knowing your own psychological weak points, your triggers, your strengths as a human being reacting to pressure, not just knowing how to read a chart pattern.
Know thyself, trader edition.
Pretty much. He's learned from figures like Philippe Petit, the guy who walked the wire between the Twin Towers. Petit spent years in meticulous physical and mental preparation. He dealt with his intense fear not by ignoring it, but by exaggerating it in his mind, thinking about spiders, which he hated so that the reality of the wire walk felt less terrifying by comparison. Petit's philosophy, life should be lived on the edge of life, really resonates with the kind of intensity and self-confrontation required to master your mind in high-stakes trading.
This intense self-mastery, this willingness to confront fear and past mistakes, it leads to what he calls the champion's mindset, which, again, paradoxically, involves truly embracing failure, not just tolerating it. That seems completely at odds with how we typically define success, doesn't it?
It absolutely does. Our culture generally tells us failure is bad, something to be avoided at all costs. But Hougaard argues it's essential for growth in this field. He cites great athletes like Kobe Bryant. Kobe, despite being a legend, actually missed more shots than any other player in history.
Wow, I didn't know that stat.
Yeah. But Kobe was willing to encounter failure in every game he played. He understood it was just a necessary part of taking the shots needed to win. Same with Babe Ruth, known as the king of strikeouts, just as much as the home run king.
So failure is just feedback, data.
Exactly. This illustrates that just practicing isn't enough. Practice doesn't automatically make perfect. As Hougaard says, it merely makes it permanent. If you practice bad habits, you just get better at being bad. True improvement comes only through a dedicated approach to practice, with a specific attention to finding your mistakes. It's about actively seeking out what went wrong, dissecting it without ego, and using that information as a stepping stone for improvement. And this mindset also leads to one of the most counterintuitive yet potentially powerful pieces of trading wisdom, the idea of pressing winners.
Pressing winners, meaning adding to trades that are already working.
Exactly. Tom recalls a really powerful conversation he had with Dr. David Paul, who asked him a game-changing question. When you're in a winning position, instead of thinking where to get out, why don't you think about where to get in more?
Whoa. Okay, that's flipping the script.
Totally. Because the common self-sabotaging mistake, driven again by that brain's pain avoidance and desire to recoup losses quickly, is adding to losing positions, averaging down. You convince yourself you can lower your average price and make back your money faster, focusing on the potential bigger profits, while conveniently ignoring the fact that you've just doubled your risk on a trade the market is already telling you is wrong.
Reset.
Hope over evidence.
Precisely. The successful champion approach, which feels deeply uncomfortable and goes against every protective instinct we have, is adding to winning positions. Why? Because the market itself is corroborating your initial insight. It's agreeing with you. Adding to a winner, Hougaard says the purpose is to stop you from taking half profits. It forces you to let your winners truly run and potentially turn into substantial gains instead of snatching small profits out of fear.
So when the market proves you right, lean into it. Yes, when you start actively thinking, where can I add to my winning trades, instead of where should I take profit, that's when you are, in Tom's words, beginning to think differently. You're aligning yourself with the market's momentum rather than fighting it or trying to prematurely end the ride.
And Tom applies this rigorously. He talks about his same-size principle for adding to winners. Can you give an example of how that works?
Yeah, it's quite methodical. Let's say he buys the Dow index at 26,629. He feels good about the trade, the market moves in his favor. He might then decide to add another position of the exact same size at, say, 26,649, just 20 points higher.
Okay, so he's adding to strength.
Right. But crucially, the moment he adds that second position, he immediately moves his stop loss on the first position up to his original entry price of 26,629, making it risk-free. And he places the stop loss on the second position at 26,629 as well.
So he's increasing his potential profit while simultaneously managing the risk very tightly on the whole larger position.
Exactly.
Yeah.
Even though his overall position size has doubled, his risk on the initial part is neutralized, and the risk on the second part is clearly defined. It's a disciplined way to let the market agree with you and then lean into that agreement even if your innate human tendency is screaming at you to run away from the increased exposure and just bank the small profit. But even with this champion's mindset, even with disciplined execution, slumps are just an inevitable, unavoidable part of every single trader's journey. Even the absolute super traders. It's not a question of if they'll hit a rough patch, but how they navigate it when they do.
It's a real test of character and discipline, isn't it?
Absolutely. It's where the mental game is truly won or lost. Hougaard shares the really tragic story of Adam, a trader he knew who was apparently brilliant. Adam developed this incredibly effective system using 30-minute charts for stock indices. He had supernatural patience, Hougaard says, sometimes just staring at a screen for hours without making a single trade, just waiting for the perfect signal.
The discipline sounds incredible.
It was. And he made a fortune, built a custom house, traveled first class, the whole 9 yards. But his downfall began over one weekend. He went maximum short the market, a huge bet that it would fall. But then news broke that Saddam Hussein had been captured.
Oh, wow, a major unexpected event.
Huge. And the American markets opened limit up on Monday morning, meaning they soared so fast and so hard, hitting circuit breakers, that he couldn't even close his massive short position until the losses were catastrophic.
Devastating.
Hundreds of thousands gone, just like that. And according to Tom, something just short-circuited in his mind. He felt cheated by the market, by the event. His discipline shattered. He started revenge trading, doubling down, trying to win it all back desperately. And eventually he lost everything, his house, his wife. He apparently even cheated Tom out of some money before disappearing completely.
Oh, man, that's a gut-wrenching story. A real cautionary tale.
It really is. And it powerfully drives home the point that education means very little in this industry. It doesn't matter where you went to school or what your day job is. If you don't know how to handle a losing trade and then a winning trade, especially during a slump, you will not go very far in this arena. A single catastrophic mental lapse can undo years of success.
It's a stark reminder that the biggest battles are always internal, aren't they?
Always. And Tom is honest about his own struggles, too. He talks about experiencing significant slumps himself. He describes one particularly grueling week where he had 4 consecutive losing days and just felt completely lost, questioning everything he was doing.
Even the pros feel that doubt.
Absolutely. The key lesson he learned from navigating his own slump was simply to slow down. Reduce size, be more selective, wait for clearer signals. Don't press harder when things aren't working. He emphasizes that slumps are inevitable. You are bearish and the market goes up. You are bullish, the market goes down. It happens to us all. But crucially, he adds, all slumps end. The key is to maintain perspective and be a process-oriented trader, trusting that if you stick to a sound, consistent approach, you will come out the other side, regardless of the frustrating short-term P&L swings. It's about focusing on your actions, your discipline, your mindset, the things you can control, not the uncontrollable outcome of any single day or week.
Okay, so all of this intense focus on mindset, on managing emotions, on navigating failure, it brings us right back to the core, almost paradoxical philosophy of Tom Hougaard's book, Best Loser Wins.
Yeah, it's such a provocative title, isn't it?
It really is. In trading, unlike almost every other aspect of life we can think of, the best loser wins. It's such a striking statement. But what does it really mean in practice to be exceptionally good at losing?
Well, it fundamentally means that consistent success in trading isn't really about having a genius-level IQ or finding some secret foolproof system or even having insider information. Tom is very explicit about this. He says he has no secrets, no special abilities, with the possible exception of one. I am exceptionally good at losing.
That's his superpower, losing well.
That, he argues, is the ultimate, most crucial skill. And think back to that David Rodriguez study of 43 million trades. Remember, 61% of those trades were winners. Yet overall, the traders lost money. This highlights precisely that it's how you lose how much, how quickly, and how you emotionally handle it that determines long-term profitability.
So it's not about avoiding losses because you can't. It's about managing them effectively.
Exactly. What's fascinating here is acknowledging that the market, especially in the short term, often behaves with near 50.5000 randomness. It's like a coin flip a lot of the time. The real difference between the consistently winning traders and the losing ones isn't their ability to predict the coin flip more accurately. It's how they approach the inevitable losses when the coin lands the wrong way. The winning traders lose small, they lose decisively, and they move on without emotional baggage.
Okay, so if our primal reptile brain, our base self, is so deeply wired for survival and fight or flight, always trying desperately to avoid pain, how do we actually recode it? How do we make it accept, even embrace, the necessary discomfort of taking small, quick losses in trading? How do we literally flip the switch on our deepest protective instincts?
It's about consciously working to expand your pain tolerance, to make the uncomfortable feel less uncomfortable, more normal. He suggests a really visceral exercise to help with this.
Okay, what is it?
Close your eyes and vividly visualize losing a large, genuinely meaningful amount of money, something that would really sting, maybe the entire cost of your car, or your kid's college tuition fund for the year.
Oof, yeah, that would hurt.
Let that potential pain sit with you. Feel the knot forming in your stomach. Imagine what you wouldn't be able to buy now. What opportunities are suddenly lost because of this imagined trading loss? Make it as emotionally vivid and real as possible, and just let that painful feeling register without pushing it away immediately.
Why do that? It sounds like torture.
Counterintuitively, doing this regularly helps you acclimatize to the feeling of loss. It expands your tolerance. It makes that level of financial pain less shocking, less paralyzing when it inevitably occurs, even on a smaller scale, in your actual trading. You've rehearsed the feeling. The key insight here, he states, is asking yourself, if you want to be a success in a field where 90% or more fail, how do you think you should approach this task? Logically, you either have to do the exact opposite of what the failing 90% are doing, or you have to rigorously replicate the behavior and mindset of the successful 10%.
Makes sense. You can't follow the herd if the herd is heading off a cliff.
Precisely. The 90%, he argues, fail because they interpret the pain messages received automatically from our reptile brain without any modification. They react instinctively, they freeze, they hope against hope, they double down in panic. The successful 10%, however, they've learned to override that initial impulse. They metaphorically run towards the danger. They lean into the discomfort. They cut the loss quickly and decisively. They adapt to the market's reality. And this ability to override instinct, that's the essence of flipping the switch. It's about consciously adopting a mindset that expects discomfort, that anticipates anxiety not as a signal to stop, but potentially as a sign that you're doing something difficult but necessary. Tom says, I expect to be uncomfortable. I expect my trading to cause me anxiety. I'm waiting for it.
Wow. Welcoming anxiety. That's radical.
It is. And it means fundamentally shifting your core mental approach to trading. He outlines a few key principles for this switched mindset. 1. Assume you are wrong on every trade until the market proves you otherwise with price action moving in your favor. Start from a position of skepticism about your own idea. 2. Expect to be uncomfortable, especially when entering or holding a good trade that goes against the crowd or your initial fear. Welcome that discomfort as a sign of proper, non-herd action. 3. Only add to your position when you are right, when the market is actively corroborating your trade by moving in your favor. 4. And the flip side, never, ever add to a position when you are wrong. Don't average down into a losing trade, period.
It's about cultivating that mental agility, isn't it? Like that quote from the legendary trader Paul Tudor Jones you mentioned. When the market was plummeting, he famously said something like, if it kept going down, I'd want to be selling it, not buying it. If it kept going down, I would sell it down to 0.
Exactly. And conversely, if it kept going up, I'd buy it to infinity. It just epitomizes that mental flexibility, that willingness to completely flip the switch and flow with the market's direction, regardless of how high or low it seems, rather than fighting it based on your preconceived notions of what's cheap or expensive or fair value.
That's a profound shift in perspective, moving from constantly fighting the market and your own instincts to flowing with it, even embracing the discomfort. But okay, practically speaking, how does someone actually build this ideal mindset? It sounds great in theory, but what's the practical blueprint for someone listening who wants to start doing this crucial internal work?
It's definitely a process, not an overnight fix. And it requires continuous effort, rigorous self-awareness, and consistent practical exercises. Hougaard outlines several key components. First, he champions creating what he calls the Book of Truths.
The Book of Truths, what's that?
It's essentially a detailed trading journal, but with a strong emphasis on the psychological and emotional aspects. You don't just record the entry, exit, profit loss. You visually review old trades. Screenshots are great, paying special attention to your biggest, most painful mistakes alongside your successes. The goal is to reinforce good behavior patterns and remain acutely mindful of your specific weak points and triggers. Crucially, you record why you took the trade, what you were thinking and feeling at the time, your emotional state, maybe even your physical condition, or what else was happening in your life that might have influenced your decision. By doing this consistently, Tom says, I became much more trusting of the markets. I trusted that I would be given an opportunity to make money every day. And interestingly, he adds, as odd as it sounds, I began to trade less and I started to make more money. This systematic, honest review builds true self-knowledge, which builds trust and patience.
Okay, the Book of Truths. Makes sense. What else?
Second, he strongly recommends Dr. David Paul's 20 trades exercise. The goal here is explicitly not to make money from these 20 trades. Instead, it's to simply execute 20 trades as the signals appear according to your predefined system without internal conflict.
Just execute mechanically, regardless of feeling.
Exactly. This is purely a process exercise. It's designed specifically to smoke out your internal conflicts and your unresolved emotions. The point is to observe your own reactions dispassionately as you execute. Do you hesitate before clicking the button? Do you feel a surge of hope when a trade goes slightly green? Do you feel fear or anger when it goes red? If you can get through 20 trades accepting the wins and losses equally, just following the process without that emotional roller coaster, you're making real progress. It's about training your response to the outcome, not controlling the outcome itself.
Right. Training the response. What's next?
Third is actively cultivating patience and belief. These two are intrinsically linked. Tom developed his own deep well of patience, he says, by doing something incredibly laborious but powerful. He went back and reviewed 10 years of historical market data for the instruments he trades.
10 years? Why?
To prove to himself, through objective, undeniable historical evidence, that profitable trading setups occur virtually every single day. There are always opportunities. This concrete proof helped him overcome one of the biggest flaws he saw in other traders. Without a doubt, one of the greatest flaws I saw traders exhibit was the idea that it's too late to join the trend.
That feeling of, oh, I missed it, it's run too far.
Exactly. They'd see a stock or index running up strongly and think, oh, it's too high now, I missed the boat. But having done the data work, Tom knew that strong trends often persist much longer than people think, and joining them, even if it feels late, is often the right move. Patience, he insists, isn't just a virtue. It's a skill set that can be developed by building that deep belief, grounded in data, that if you miss one opportunity, one train, another valid one will inevitably come along if you just wait for your setup. It helps push against that ingrained supermarket mentality to always be looking for bargains in falling markets.
Okay, so Book of Truths, 20 trades, exercise, building patience through data. What else is in the toolkit?
Fourth, he incorporates specific techniques for managing his state in the moment, primarily breathwork and imagery. He uses simple but powerful breathing techniques like breathing in slowly for 7 seconds and out even more slowly for 11 seconds, specifically to calm his mind and regulate his nervous system when feeling stressed or anxious during a trade.
Getting control of the physiology.
Exactly. He also uses mental imagery in a fascinating way. He deliberately places himself mentally in imagined dangerous, high-stress situations, like facing an alligator or clinging to a steep rock face. He does this to intentionally elevate his pulse rate, to simulate the physical feeling of fear and stress. Then, while holding that stressful image, he consciously focuses on his slow, controlled breathing to remain calm and composed despite the perceived danger.
Wow, like stress inoculation training?
Precisely. It's a technique used by high-performance athletes and special forces. It trains the mind and body to remain composed and make rational decisions even under extreme stress. And that's directly transferable to the intense pressures of real-time trading when your money is on the line.
That's intense. Any other processes?
Fifth is a process he calls ask for help. This isn't about asking other people. It's an internal process for dealing with limiting beliefs that hold you back. For instance, maybe you have a deep-seated fear of joining a downtrend because buying dips feels safer.
Okay, so how does ask for help work?
First, you acknowledge the belief clearly. Then, you write down all your uncensored thoughts and feelings associated with that belief, no matter how irrational they might seem. Just get it all out. Next, you consciously accept the belief without judging yourself for having it. You just acknowledge, okay, this is a belief I currently hold. Finally, you work to diffuse its negative charge, perhaps by questioning its origins or validity, understanding that often, I will see it when I believe it, meaning our beliefs shape our perception. Instead of fighting the belief or trying to suppress it, you accept it, understand its root, and then, paradoxically, it often begins to lose its power over your actions. It's about bringing the unconscious drivers into conscious awareness.
Acceptance and diffusion, not suppression. Okay, so putting it all together.
Finally, he describes how these elements create and sustain the mind loop of his ideal mindset. It starts with trust. Trust in the markets to provide opportunities, built through data analysis like his 10-year review, and trust in himself to follow his process, built through the Book of Truths and exercises. This trust supports patience the ability to wait calmly for the right setup, knowing opportunities will arise. Patience, in turn, feeds confidence, not arrogance, but a quiet confidence that he will win over time if he sticks to his process. This confidence dictates his inner dialogue, fostering positive, process-oriented self-talk, often simply reminding himself to just flow, letting the trade unfold without interference. And this constructive inner dialogue supports his process-oriented mindset, enabling him to stay focused purely on executing his rules in the present moment, regardless of the outcome of any single trade.
It's a virtuous cycle.
Exactly. And these mental exercises, the journaling, the breath work, the belief work, they constantly feed, nourish, and sustain this powerful loop. He sums it all up with that core philosophy. The one who is best able to lose will win the game of trading. At the end of the day, it's not about how much market knowledge you can cram into your head. It's about how you respond to the market's constant flow of information and emotion, and how rigorously you evaluate and refine those responses over time. #outro.
Wow, what an absolutely incredible journey we've taken today, deep into the mind, the psychology of a high-stakes trader. It's become crystal clear, I think, that consistent trading success isn't really about traditional market expertise or finding bargains or predicting the future.
You know, none of the usual things people focus on.
Instead, it's profoundly, almost entirely, about mastering one's own psychology. It's about learning to embrace discomfort, managing fear, and, as we've explored so deeply, counterintuitively becoming the best loser by handling those inevitable losses effectively and unemotionally. This journey, as Tom Hougaard so powerfully reveals through his own experiences and insights, is ultimately internal. The true missing link for so many struggling traders isn't more market analysis, it's deeper, more honest self-analysis.
And that really is the powerful, lingering thought we want to leave you, the listener, with today. As Tom himself concludes in his book, and it's a great point, I don't describe the way, I describe my way. Whatever you decide is right for you is right for you. Trust it. So maybe the challenge for you listening is to consider, what would your own Book of Truths look like? What are your recurring self-destructive trading behaviors, or maybe even just life patterns that you need to acknowledge honestly and start reframing?
What would happen if you genuinely committed to that 20 trades exercise, not aiming for profit, but purely to smoke out your own internal conflicts, your own unresolved emotions around risk and money?
Because ultimately, this isn't just about trading charts. It's about how your individual relationship with fear, with failure, with discomfort, and with self-awareness is defining your growth and progress in all aspects of your life. It's a
Yeah.
universal challenge, really.
Absolutely. We really hope this exploration has given you a fresh perspective, maybe some new tools, and perhaps even the courage to begin or continue your own crucial internal journey of self-mastery.
Keep digging deeper.
Until next time on The Deep Dive.